Here we go, everyone. This is Google. And we got the reversal from an extreme weekly overbought level. This is a 3 minute market maker platform. We've gone straight down. The range is 1247. We're $12.06 on the reversal high finally, where 3 days in a row on this 3 minute chart, it started over here with a gap. And we can clearly see here that what I want to show here is that a reversal is never confirmed until it breaks below where the gap started to the 52-week high, period. So we still have a ways to go, and that it's one of the best bull stock trends out here on the planet right now, but it's overbought, and they have to come down. And when they're overbought, as Google is, and the high frequency algorithms ran it to all-time highs 3 days in a row, and I'll be happy to show on a weekly level, just so people understand. Here, let's put Google in here, G-O-O-G, and let's go over here. I'm going to right click, I'm going to blow up this part of the chart of what it looks like on a weekly up here at an all-time high. The most important thing about this one, MMTs, just so everyone knows and whatnot, is that the percent DS is 91.86. It peaked at 94.43 on an overbought level, meaning that the high frequency algorithms had just shot these things to the moon in artificial buy programs that are done by high computing cycles. I don't have to go into that. Apple, I'm just going to update that lower low. That short gap down, they're selling down. 5IR, I just threw that in there. Once again, what we are looking for is how Google works off the overbought process. The 805 put was marked down to 360 and it hit $10.10. That was a huge trade because it finally had the reversal, as every price in overbought cycle should. Eventually the calls, the 790 call right here that was so inflated, I said they had to come down and these had to go up on the 805 puts. And this is the first day of it, but you cannot stay inflated. And what do I mean by inflated? Here was the put option right here for the people in my market maker pit. As far as the option market maker pit goes, these things were up here at $19.50. They mark them to 360 over here. This is a daily 805 put. That was a big imbalance. Now, let's take the 790 call that was in the money. This thing was so inflated up here, it had to give back its gains. And it still has to come down. It still has to come down in value. Now, in high frequency algorithms that are used to pump stocks versus humans buying, you can see that that up move on Google right now is $2 off the bottom, which will bring the fact that the 790 call, we're going to look at it, it's still overbought and needs to come down. And the put side, mathematically, I can put up another daily chart, which I'll be happy to do, and I'll show you the imbalances. So let's take a look here at a 790 put that was marked down to almost nothing. 5 days ago, these very same contracts here were at $13.40. The low today, or today's low, $1.10. And they come up. So, based on inflated and based on mathematical deflated, is that when a stock in the very, very short term has ran to 52-week highs, it inflates it. Everyone gets stuck in the calls up here, but the puts are the most deflated side of the market at wholesale entries with the least amount of risk, when the stock itself, Google, and I'll show you a 3 minute. The IR ranges are at the lower end of the level. When it was in its bull run and high frequency algorithm buy programs done by machines, and they just kept walking it higher and higher until they couldn't go anymore. And it always has to confirm with the day that starts like this. You shoot it right up, but when it pulls back, it bounces. It's a narrow range bounce from the highs, MMT, and identifying the weakness right here. And then it pops up, and then you get a sell. But every time, notice the amount of red bars today from the overbought. That was the last 52-week high. That's the kind of validation we look at. Now, on the flip side, once the overbought process starts to work itself off, is how it will bounce off of this bottom, or what pricing levels will it bounce off of. I'm going to show a 60-minute chart. One thing about Google on the 60-minute chart, we're coming down here where that first gap up on that 60-minute happened. And this is the 60-minute chart, how the high-frequency algorithms wind it up in the buy scripts, which a lot of people will don't even know what I'm talking about. The people in the school do for sure. And the prices don't lie. So, when we identify a one-way parabolic breakout move, whether it was bought by humans or high-frequency buy scripts that ran it to these highs, is that they get that overbought and you come down. But just remember that until it breaks below 796, it's a tradable bottom, meaning that, yes, the calls and the puts are both inflated and deflated, but because this name is so strong that the bottoms get 300 penny bounces like it's doing right now. You peaked over here on the 805 put. You went from 360 to 1010. The only thing you can do now is that the put side is still deflated, really. It's not at 420 close. You finally got some movement on this side of the market where the money is printing. However, on the 60-minute, we just want to be mindful of one thing, MMTs, is that this 60-minute bar is green right at this 60-minute line. That's a mathematical price that has support, and the IR is 20. The range is 1247 here on the 60-minute, but we have to break that lower teeny line and come down, and in here mathematically we've got to get back below that diamond, and each one of these lines on a 60-minute chart is $2.93. That is a 1/4 delta movement that equals that dollar amount. The half bar that we have to witness is here. That 799.43 on a 60-minute half bar. We have right now undercut that half bar right here in the video. You can see we're here. Let's pull the Google up here a little bit. So let's go back and fetch the 60-minute. Now let's pull this up here so we know that it's in here for the MMTs. The 60-minute half bar is right here, MMT. He undercuts it and he's back above that bar. That half bar is down here. Let's pull it up here so that you can see it. It's in the info panel right here. That's the half bar column, 799.43 pennies. And he undercuts that 60-minute half bar, but he has to close below the 60-minute half bar, and the 60-minute half bar has to become resistance. And that the reversal has to still continue to build price weakness, and that the 805 put that closed at 420 had an intraday move. The call side here of the 790 to this time is 8:49 a.m. Pacific Standard Time. They were $19.91 on the high, and they finally took $10 out of it because they were inflated. They were, and I showed it on a chart. Now that we found the bottom of that inflated call, coming down in its value is where this side of the market is tradable for a quick entry and a quick exit here. and then continuing to look at this 805 put based on the decisions is based on clearly the 60-minute chart and how that bottom support of this 60-minute bar is a leverage back up $2.93. That was a gap down bar, which we haven't seen any of those on a 60-minute level. Gap down below the teeny and ran right here and tested it. That is because the name itself has bounced off of the bottom, which has taken the short-term trade here. We're exiting between $11.50 and $12 and learn how to exit the call based on that first bounce of that support level of the 60-minute bar here at $799.43. He undercut it and he whipped right back above it. Once he goes below it, the call side will have made its intraday move. And trading this call side off of the bottom when they do get deflated, they're good for a short-term trade. No one said to hold on to it and fall in love. No. The put side is coming down off its peak value, 750 by 8. Still well above 4.2 close and $3.3 with a $6.50 range. This one has a $10.61 range on the 790 call, $19 down here to wholesale, and then selling out now. Selling out now. Because when he breaks below that half bar, that was the first intraday bounce. Time, 8:51 a.m. Pacific Standard Time, 2/20/2013. You need to get involved right now. StockMarketFunding.com. Name, email, phone number, do the referral. Number one, all of these are live videos. This one's going to be uploaded. The 450 call trade, that was just the opening bell. We went a lot lower there on Apple. But all of your things that you need to have as your witness is in the live entries and exits at wholesale prices as a market maker. You need to get over here to the SMF exchange and click on it, and the options exchange. We cover both pits. And they're both trained together in a monthly level with market maker entries and exits and profits. Not only that, go to trading and open an account. Click on it. Look at all the benefits you get. Things you're not even aware of what you get. Once you get away from, you're going to get buying power no matter what. $2,500 account's going to get you 6 to 1. I'm going to give you $15,000 intraday. That way, you don't get that at TD Ameritrade, and you know it. Or any of the other major outlets of retail online discount brokers, such as all of these down here. And you're handicapped. And you have the pattern day trading rule. You know it. You suffer from it just like the rest of the world. You don't have to anymore. Click on open an account here. If you have an account here and you're getting market maker entry and exits, I give you 15 to 1 on $10,000. Titan Trading LLC, 150,000 intraday. That's what they're ponying up just for you. And then here's the beautiful thing. You get to get big trades at certain times when the calls have to come down and the puts have to come up. And we're working with the trader network worldwide with the SMF Market Maker Exchange pit. We own our own pit, and it's done mathematically, and it's here to make money. And people can't deny the price movement and the time to get into the transactions. Mathematically, we came down almost one full delta, finally, and we're $3.77 above it right now. But that is a reversal and a support level. And once again, here is the equity level below the half bar that we talked about slightly. The calls made their move. You had to sell them at the highs. The puts finally pull back, but they don't go lower. And that is the evidentiary. The put side of the market got so deflated. That's when we want to let when a extreme bull trend gets so overbought and gets manipulated with a buy script that goes parabolically up with algorithms that drive the prices higher using buy scripts that are created by supercomputers and machines. It's called high frequency trading. And they run that thing and they just keep running it until it has to have that reversal. And that's a big day. But the calls had to come down and you had to sell them just like you can buy the bottoms, but you got to sell quick. You get $2 out of these things off of the bottom or $1.50, you're gone, based on the fact that we are finally working off that weekly overbought and that short-term 3-day price movement that happened Thursday and Friday of last week. Then it started on the light volume week on Tuesday. This is the fourth day. The fourth day. And it went 3 days up out of 5. And then on the fourth day, you have a pullback. And that the calls were inflated and the puts here live were deflated, and buying wholesale down here and getting paid that money is what you want to do. And I'll tell you, you need to get here now if that's what you want to experience. And we're going to leave it at that. And it's a special for our new trader network who has for many days and years wanted to be able to get wholesale in the put over here and buy wholesale in the call as well. They both make money. But right now, Google is pulling back, and I will go back to the 3-minute chart with my MMTs. And what will I do is I will show you here again in the market maker panel in our application. This is not a day trading application. You need to learn more about it. When this thing was descending in value, you got the sell signals, you got the lower diamonds, you got the breakdowns, you come off the bottom in volatility because it's a strong bull. 1, 2, 3, 4, 5 teeny scripts at how much is 16th? What is a teeny? It's 73 cents a line. That's what the price. So 1/16 equals 73 pennies to the penny. Right up here, it came 5 teenies off the bottom times that many pennies per 16, 73. It's below 25 IR. It finally had a negative 0.88 ratio, minus 14.13. Now, just let me tell everyone about bull trends and bull markets and whatnot, is that every stock, whether it's in a high frequency buy program or sell program, is that you need to understand one thing, is that when they come off the bottom mathematically, 5 teenies, that's 5 teenies, that equals 73 cents times 5, or 5 times 73 cents. Look at how accurate it is. Look at where the diamond resistance and how that diamond is closing below there, and how the half diamond has come back into play. Here is the equity. It's strong and will continue to be strong. The lower that it goes on its first $12.40 reversal from the high down, that's confirmation that the trend itself in price, that's what the public refers to it, we're market makers. And what we look for specifically is where the imbalance, mathematical equation of imbalances take place, and how prices continue to weaken up. Unlike the 60-minute chart, you're below that half bar. And this is live in the marketplace, and the put side paid big money. From 360 to 1010, it's pulled back. It's still marked down. These that are losing 747, 1991, $10.61 down. They cannot stay up there in that inflated zone. Never. And we'll teach you how to do that. Get to stockmarketbunny.com. Get your buying power and get into that market maker pit.